Something is brewing with silver right now, while you're watching this. A major sovereign mint just sold almost nothing. Zero for an entire month. That has only happened once before, and it was December, not May. And 3 days before a critical government deadline on mineral price floors, that same mint is about to release silver, priced at levels nobody can explain. Not through collector value, not through rarity, something else. The math behind these new coins doesn't match history. The gold to silver ratio they used is less than half of what the market has shown for decades. Either someone made a very expensive mistake, or someone knows something the rest of the market doesn't. And the timing is the part that should concern you most. Now, before we go further into this story, I want to ask you for something. Not a favor for us, a favor for yourself. If you are the kind of person who likes to know what is happening before it becomes obvious to everyone else, before your neighbors, your colleagues, the people at your local market are even talking about it, then subscribing to this channel is simply common sense. Think of it the way you would think of checking the weather before a long journey. You do not have to, but a wise person always does. So go ahead, press that subscribe button now while you remember to, and tell us in the comments, where are you watching this from today? We would genuinely like to know which city, which country is paying attention to this story with us. Now, let's get into what is really going on with silver. On the surface, the story looked simple. Silver was falling, gold was falling. Analysts blamed it on the usual suspects: a stronger dollar, a central bank holding interest rates steady, and a conflict overseas that refused to settle. Most people watching the markets that day saw nothing unusual. A red day, a dip, nothing more. But for those who study institutional behavior rather than just price charts, something did not add up. Buried inside a routine government report was a number that should have caught everyone's attention. For the entire month, a major sovereign mint had sold 0 ounces of its most popular silver coin. Not a small amount, not a slow month, 0. This was not the first time it had happened, but every previous time it happened in December, the final weeks of the year when mints typically pause sales to prepare for the next year's coin designs. It was expected, it was routine, it made sense. This time it happened in May, the middle of the year, with no design change, no scheduled pause, and no obvious explanation. For a business audience, a single unusual data point rarely means much on its own. Markets are noisy, anomalies happen. But this anomaly did not arrive alone. It arrived alongside a second, much stranger development. Just days after that report became public, the same mint announced a new release, limited edition gold and silver coins, scheduled for the following month, and the prices attached to these coins immediately drew attention from analysts who track precious metals closely. The gold coin was priced at nearly $20,000 for a single ounce. The silver piece, even smaller in size, was priced at a rate that worked out to roughly $1,500 per ounce. To put that in perspective, the actual market price of silver that same day was sitting far below $7 an ounce. The mint was charging more than 200 times the spot price for silver. Now, collectors understand that limited edition coins often sell above market value. Rarity has its own price. A coin with a small production run, a unique design, or historical significance can reasonably sell for more than its metal content. This is normal, expected, and has happened for decades. But 200 times the market price is not a normal collector premium. It is something else entirely. This is where careful analysts began asking a different kind of question. Not why is silver falling, but why did this mint suddenly stop selling silver to the public, and then a few days later announce silver products priced as if the metal itself was worth far more than the market says it is? It is the kind of question that, on its own, might be dismissed as coincidence. Institutions make pricing decisions for many reasons: marketing strategy, limited materials, internal cost structures. None of this is necessarily suspicious by itself. But for those who have spent years studying how governments and central banks behave before major policy shifts, this pattern felt familiar. Big institutions rarely announce major decisions without small, quiet signals appearing beforehand. A pause in supply, an unusual price, a release date that seems to avoid drawing attention rather than seeking it. And that is exactly what made this situation worth following closely. Because this release was not scheduled for a date with obvious symbolic meaning. It was scheduled for a date that, at first glance, seemed almost random. No major holiday, no anniversary. No clear reason to choose that specific day over any other, except for one detail that almost nobody noticed at first. That release date fell just 3 days after a government deadline. A deadline tied to a decision about price protections for critical minerals. A decision that, for the first time, included silver on the list of materials being reviewed. 3 days, not 3 weeks, not 3 months, 3 days. For a business owner, an investor, or anyone responsible for protecting capital, timing like this is rarely accidental. Institutions plan months, sometimes years, in advance. A release date chosen just after a major regulatory deadline is either a remarkable coincidence, or it is evidence of something being prepared quietly, away from public attention. And once that piece of the puzzle is added to the zero sales, the unusual pricing, and the unexplained pause, the picture starts to shift. What looked like a simple market dip outside started to look like a story unfolding behind closed doors. A pattern was forming, and patterns, as any serious market observer knows, rarely form without a reason behind them. The question now was no longer whether something strange had happened. It clearly had. The question was what came next, and whether the people paying close attention were the only ones who would benefit from knowing it in advance. To understand why a quiet pause in silver sales mattered, one had to step back from the mint itself and look at the larger machinery driving global money. Because the story was never just about coins, it was about what governments and central banks were quietly preparing for, long before the public noticed. 2 days before the silver anomaly came to light, the central bank had held a routine meeting. On the surface, it was uneventful. Interest rates stayed the same. A new committee member spoke briefly, repeating familiar language about supporting employment and controlling prices. Reporters wrote their usual summaries. Markets reacted the way they always do to no change, with mild disappointment and a slightly stronger currency. But for those trained to read between the lines, the meeting confirmed something more important than the rate decision itself. The central bank signaled that rates could move higher later in the year. A stronger currency was the immediate result. And a stronger currency, historically, puts pressure on metals priced in that currency, gold and silver included. This explained the short-term dip. It did not explain the deeper pattern. Because while currency strength was pushing prices down on paper, a much larger and slower shift was happening underneath. For more than a decade, large central banks around the world had been quietly changing what they held in reserve. Government bonds, once considered the safest possible asset, were being reduced. Gold holdings, by contrast, had been rising steadily, year after year, without much public announcement. Recent data made this shift impossible to ignore. The total value of gold held by central banks had now surpassed the value of government bonds held by those same institutions, and not by a small margin. The gap had grown to roughly $1 trillion in gold's favor. This was not a one-time event triggered by a single piece of news. It was the result of years of deliberate decisions, made quietly by people who manage national reserves for a living. People who do not react to headlines. People who plan in decades, not days. For a business audience, this distinction mattered enormously. Retail investors often buy and sell based on emotion, reacting to daily price swings. Central banks do not operate that way. When an institution responsible for an entire nation's financial stability begins shifting its reserves away from paper assets and toward physical metal, it is rarely doing so on a whim. It is preparing for something, currency instability, inflation risk, or a longer-term loss of confidence in traditional reserve assets. And this was the environment in which the silver anomaly had occurred. Not in isolation, but inside a broader pattern of institutions, quietly repositioning themselves. There was one more piece of the policy backdrop that deserved close attention, a piece many casual observers had completely missed. Months earlier, a formal government order had been issued, instructing trade officials to study the possibility of setting price floors for materials considered critical to national security and economic stability. The list included rare industrial materials most people never think about, but it also included two metals that ordinary investors knew very well, copper and silver. The order required officials to deliver their findings within a fixed window of time, 180 days from the date it was signed. That deadline was approaching fast, and it placed the conversation about silver in an entirely different category. This was no longer simply a precious metal traded by collectors and jewelers. It had been formally classified, by government order, as a material critical to the country's economic and strategic interests. When a metal receives that classification, the rules around it can change. Price floors, trade restrictions, even stockpiling by government agencies become real possibilities. Tools usually reserved for materials considered too important to leave entirely to free market pricing. For business leaders and serious investors, this detail mattered more than any single day's price movement. A temporary dip caused by interest rate expectations is noise. A structural shift in how governments classify and manage a material is signal. And when the timing of the mint's unusual silver pricing was placed next to this approaching deadline, the pieces no longer looked random. A pattern of institutional behavior was forming, one shaped not by daily headlines, but by decisions made quietly, months in advance, by people few members of the public ever see or hear from directly. The next question was simple, but important. If officials were preparing something around this deadline, what would the pricing signals already visible in the market reveal about what they expected to happen next? Numbers rarely lie, even when the people behind them choose to stay silent. And buried inside the mint's new pricing structure was a number that told its own story, long before any official statement could. To understand it, one had to look past the headline price tags and focus on the relationship between them. The gold coin was priced at nearly $20,000. The silver piece, smaller in size, carried a price that worked out to roughly $1,500 per ounce. On their own, these numbers seemed simply expensive, but when divided against each other, they revealed something far more interesting. Historically, the relationship between gold and silver prices, known as the gold to silver ratio, has typically ranged between 60 and 90 to 1. In simple terms, it normally takes 60 to 90 ounces of silver to equal the value of a single ounce of gold. This ratio shifts over time, but rarely by a dramatic margin, and almost never overnight. Yet inside this new pricing structure, the implied ratio came out to roughly 13 to 1. 13. Not 60, not 80. 13. For anyone familiar with how these two metals have traded against each other for the better part of a century, this was not a small discrepancy. It was a number so far outside historical norms that it demanded an explanation. There were two possible interpretations, and serious analysts considered both carefully without rushing to conclusions. The first explanation was simple and far less dramatic. These were limited edition numismatic products, items priced based on rarity and collector demand, not strictly tied to the metal's market value. Mints frequently price commemorative items well above spot price, and the people setting these prices may have simply chosen numbers based on production costs, marketing strategy, or anticipated collector interest, with no deeper signal intended at all. The second explanation was more unsettling and far more difficult to dismiss entirely. If someone inside an institution with early access to non-public information believed that silver's value relative to gold was about to shift dramatically through a price floor, a supply restriction, or a broader revaluation, then pricing a product today using tomorrow's expected ratio would make a strange kind of sense. It would not be proof, but it would be a signal worth noting. Neither explanation could be confirmed with certainty, and any serious analyst needed to say so plainly. Internet commentary had already begun circulating wilder theories, suggestions of a planned currency revaluation tied to a national anniversary, ideas that quickly spread through trading communities and speculative forums. These theories made for exciting headlines, but they lacked verified evidence, and treating them as fact would do a disservice to anyone making real financial decisions based on this information. What could be stated with confidence was narrower, but still significant. The pricing structure was unusual, the timing was unusual, and the combination of an unexplained sales pause, an oddly compressed pricing ratio, and a release date positioned just days after a major regulatory deadline formed a pattern that deserved attention, regardless of which explanation eventually proved correct. This is precisely the kind of signal that disciplined market participants learn to watch for over time, not because every anomaly leads to a major event, most do not, but because the participants who consistently identify real shifts before they become public knowledge are rarely the ones reacting to headlines. They are the ones who notice when the numbers stop behaving the way they normally do, and who ask why, long before an official explanation arrives. The pricing signal alone did not prove that a major change in silver's value was coming, but it added another layer to a story that was no longer easy to dismiss as coincidence. And it raised a question that mattered more with each passing day. If institutions were already pricing future expectations into today's products, what did the underlying demand for silver itself suggest about where this was heading? Behind every pricing anomaly, every policy deadline, and every unusual institutional decision, there exists a simpler force that ultimately determines value over time: demand. And when it came to silver, the demand story had been quietly building for years, largely ignored by anyone focused only on daily price charts. Silver had long been viewed primarily as a precious metal, something held for safety or tradition, similar to gold, but that view increasingly missed half the picture. Unlike gold, silver was deeply tied to industrial use, particularly in one of the fastest growing sectors of the global economy: renewable energy. Solar power generation required silver in significant quantities, used in the conductive components of solar panels. As nations around the world expanded solar infrastructure to meet growing energy demands, the consumption of silver climbed alongside it. Recent industry analysis had shown something remarkable. Across Asia, solar power generation had overtaken natural gas to become the region's third largest source of electricity. This was not a small regional trend. It represented one of the largest energy transitions in modern history, and every stage of that transition required more silver, not less. This demand did not pause when prices dipped on a given Friday afternoon. It did not respond to a single Federal Reserve meeting or a stronger dollar. Industrial demand operated on a different timeline entirely, driven by infrastructure projects, government energy targets, and manufacturing commitments that had already been set in motion years in advance. This is where the full picture came together for serious observers. On one side, structural demand for silver was rising steadily, driven by a global energy transition that showed no signs of slowing. On the other side, supply signals were behaving strangely, a major mint pausing sales entirely, followed by pricing that implied expectations far outside historical norms, timed just days after a regulatory deadline tied to critical mineral protections. Individually, each piece of this story could be dismissed. A sales pause could be explained by internal scheduling. A pricing anomaly could be explained by collector premiums. A policy deadline could pass quietly with no major announcement at all. This was, and remained, a real possibility that any honest analysis had to acknowledge. But taken together, these pieces formed something harder to ignore, a pattern in which rising long-term demand was colliding with short-term supply signals that did not behave the way history suggested they should. For the business community, the entrepreneurs, and the serious investors watching this unfold, the conclusion was not a prediction of certain outcomes. No credible analysis could promise that a price floor would be enacted, or that a dramatic revaluation was imminent. Those remained open questions, dependent on decisions still being made behind closed doors. What could be said with confidence was this: when structural demand is rising, when supply behavior becomes unusual, and when regulatory deadlines align suspiciously with institutional pricing decisions, attentive observers do not wait for confirmation before paying attention. They position themselves to understand the situation fully, study the data as it unfolds, and avoid being among the last to recognize a shift that had been building quietly for months. Markets rarely announce major turning points in advance. They leave traces, small, easily overlooked details that only become obvious in hindsight. The Mint's empty sales report, the compressed pricing ratio, the deadline sitting just 3 days away, individually whispers. Together, something worth watching closely. What happened next would determine whether this was simply an unusual month or the early signal of something far larger already in motion.